You don't need to be accidentally invited to a top secret government group chat to find out what's really going on the mortgage market. In fact, we're going to tell you everything right here on the rate stuff and the spring statement. How would you decode that, Peter?
Well, on the face of it, it seemed fairly banal, not a lot really happening. But when you look at some of the numbers below the surface, there's quite a few little red flags.
I'd say, yes, more red flags than a Politburo day out to Yarmouth. This is the rate stuff. I'm Jack Izzard.
And I'm Peter Stimson.
Stay with us as we unpack what the spring statement means for you and for the mortgage market. No red box, no tax rises, no rabbits out of the hat. The spring statement was not a repeat of the autumn budget. In fact, it was dominated by forecasts rather than policy announcements, and the forecasts, which came courtesy of the OBR, were a mixed bag, Peter. If we start by looking at growth, that I suppose is the biggest shock. Back in October, the OBR were forecasting GDP growth of 2% for this year. They've now halved that to just 1%. So not great on economic growth, is it? We're slowing badly.
We are slowing badly. There's a number of factors. I think a lot of companies are reporting, a slowdown in hiring. We've obviously got tariffs on the horizon. We've obviously had steel and aluminium come in at 25%, and a lot of steel companies are reporting orders being cancelled, particularly from the US. And obviously we've got the tax or additional national insurance tax coming in next month. So there's kind of a lot of noise around slowing of the economy.
I mean, to be fair, the OBR is predicting that GDP growth will expand to 1.9% next year, but that's a long time away, isn't it?
It's a long time away, and bearing in mind the 2% forecast was October last year, and they've already halved that to 1%. So without being disrespectful to the OBR, I think the 1.9% at the moment is a little bit nefarious.
Pie in the sky.
Not quite pie in the sky, but I think, given that we're 12 months away from that, I think it's a little bit, suck it and see at this stage.
Bank of England sitting there looking at that thinking, we've got to stimulate this economy. But there was a rather worrying warning from the OBR on the inflation side, wasn't there? And this is, I think, perhaps even more concerning because it forecasts that inflation through 2025 will average 3.2%.
Yes, I mean, on the face of it, it does look quite puzzling. I think we've always known that inflation is going to spike in the sort of late spring, early summer months. So to take an average of 3.2 does seem pretty high. We know we've obviously got more energy costs to push through into the system. We've obviously got wage growth to push through in the spring months because obviously a lot of pay rises come through in the sort of early spring months as well. Again, we've got the national insurance costs to be pushed through, which may well get pushed through into higher goods and services costs. So we've kind of got this bulge that's going to push through in sort of April, May, potentially June time as well. We're expecting that kind of after the sort of that wave comes through, inflation will start falling off in the sort of latter half of the year. And the OBR is predicting inflation falling to 2.1% in 2026. But yeah, 3.2 was probably slightly higher than I was expecting.
Okay, so if the OBR's forecasts are in the right ballpark, things much more comfortable on the inflation front next year. But this year, it's tricky. I mean, the Bank of England's got its classic dilemma. Growth is slowing badly. Its instinct is to cut interest rates to stimulate growth. But that inflation is proving really sticky, isn't it? So how are the swaps market reacting to that?
It's challenging. We're putting a swaps graph up now so you can have a look. The markets are kind of pricing still nearly around 2 cuts this year, but probably one of the cuts is probably almost pushing into 2026 now. So looking at probably 1 cut sort of midsummer, maybe late summer, 1 cut towards the end of the year, beginning of 2026, like I say. Whether the markets are right or not is a matter of debate. The markets are often as much wrong as they are right. It really depends how quickly inflation pushes through and how the UK economy performs, I think. Growth might become a slightly bigger imperative if the UK economy, particularly underperforms. At the moment, the governor doesn't have a lot of wriggle room given where inflation is. I think, if we get any signs that inflation is kind of levelling off or maybe even starting to fall, the bank may well decide that it's got some opportunity to cut.
Okay, let's get granular on mortgage rates because that's what we're all about on
Yes.
this show. So we're talking about 2 base rate cuts perhaps over the next 12 months or so. So a fairly slow pace of cutting.
Yeah, I'm probably slightly more optimistic or pessimistic depending on your view. I personally think we might get a third, but that's more to do with the state of the UK economy, but that's where the market's pricing it.
Okay, note to self, I'll hold you to that, Peter.
Yeah.
But let's talk about what lenders are doing, because that's what we want to focus on here. So a slow cut in base rate over the next 12 months or so, and yet we're already seeing lenders cutting aggressively below swap rates even.
You've got one or two lenders pricing at or below swap, and the sort of 60% LTV rates are kind of 5 to 10 above swap, which is very aggressive pricing. I mean, typically you'd see lenders pricing 20 to 30 at least above swap rates to have some margin. So, I know brokers are probably going to get very small violins out for the lenders here, but it's very aggressive. There is very, very little margin. So lenders, believe it or not, are doing their very best to kind of price to the bone and give brokers and customers the very best rates at the moment. Personally, I don't think it's sustainable for any long period of time, lending at that kind of level. So, 3-6 months out, are lenders going to be pricing with that level of margin? I personally doubt it.
Last year on the election trail, the Labour Party made great play of being the party of builders, not blockers. And now in government, it has become a central plank of their policy agenda. And we heard the Chancellor rattle through some of the greatest hits in the spring statement this week. Peter, some of these we know before, but some were new. The Planning and Infrastructure Bill, well, that's now been passed. That will make it easier for developers to build new homes. But we've had a couple of other new things as well. There's a plan for 18,000 new social homes and a scheme to get more skilled construction workers, 60,000 carpenters, electricians, those kind of skills that we need to build the houses. So good on vibes, good on impressions. Is it really enough?
I think the jury's probably out, but I think at the moment it's kind of steady as she goes. I think you need to look at things in the scheme of things, really. We've not been building enough homes for 20 years, and it's a little bit like turning the oil tanker. By any scheme or any sort of real measure, we're about 3 million homes short of where we need to be, hence why prices are so high and why you're looking at probably at least 8 times income, which is not realistic and sustainable by any measure. So, it's taken sort of 20 years to get into this mess. It may take a similar time to get out from it. And you need the building blocks in place. You need the electricians, bricklayers, plumbers. You need the ability to build homes in areas and get planning in a reasonable time frame. And you need the finance available. So, the government is doing the right things and making the right noises. Whether it manages to achieve it, we'll see. But you need to give them a bit of time, I think.
Yes, so you've got to give credit where credit's due. They are making the right noises, but it's quite striking how little money the government has got to play with. I mean, those 2 big policy announcements that we saw, the numbers attached quite small. So those 60,000 skilled construction professionals, only 600 million to put into that. And then this social housing programme, 2 billion for that. So pretty small beer in the grand scheme of things. Why are the government's hands so tied on the money side?
You're right. I mean, money is very, very tight at the moment, and it's not a political thing. I think whichever party was in power would have a very similar problem at the moment. Quite simply, they can't raise taxation because it's not politically acceptable to do so. They can't really borrow any more money because the markets would find that very unpalatable, very unacceptable, and the gilt yields and the swap rates by default would go up significantly. We saw what happened in October when the government borrowed for growth. We had a sort of a big spike in swaps as a result and gilts as a result. So the only way they can effectively sort of, try and raise some money or release money is by efficiency savings through different government departments, which we're seeing at the moment. The government has been a little bit hamstrung by the increased cost of borrowing or government debt. Interest on the government debt at the moment is around 94 billion a year. They faced increased cost on that because there's been an increased cost of gilt yields and swap rates. So in the same way that we've seen swap rates go up since October, the government, and it's cost people effectively more on mortgage rates, the government's faced the same sort of increase in costs in the same way.
So it's almost like the government is feeling the same pain as the average mortgage borrower. Money is tight, the cost of borrowing is a lot higher than it was.
Exactly the same pain.
Okay, so thank you very much, Peter, for your analysis today of the Spring Statement. We will have more deep dives on what's going on the economic picture and the political picture and what they mean for the mortgage market right here on The Rate Stuff. Do join us then.